Third quarter earnings season kicks off this week, so what should investors expect? Welcome to Market Insight, I'm Thomas Warner. 79% of S&P 500 companies beat earnings expectations during a bonanza second quarter. Forward guidance was also upbeat, but with the wider economy cooling and valuations already sky high, could we be in for a few surprises? With me to give his take is Randy Watts, Senior Portfolio Manager at O'Neill Global Advisors. Welcome, Randy. Before we look at those Q3 earnings, you are in Florida, thankfully on the opposite coast from the Tampa Bay area. Do you have any updates on how things are looking at the moment?
I mean, obviously, Hurricane Milton is going to be a historic storm. It's been moving slowly and really expanding in size and speed. Right now, the winds are just a little bit under 150 miles per hour. If it's at this strength and it hits the Tampa area directly, estimates are that up to 700,000 homes could be destroyed, and it's likely that losses will be over 50 billion. To give viewers a little perspective, about 3% of U.S. GDP is in the path of the storm. So it is a big storm. We're obviously praying for very little loss of life, but Tampa and the middle of Florida is going to take a real hit.
Let me second those well wishes as well, but let's look at those Q3 earnings. We have had Barclays suggesting that Q3 may represent a little bit of a low water mark ahead of a rally into the new year. Is that a theory that you're buying?
I think the most important thing to realize about Q3 earnings is that during the course of the quarter, earnings estimates actually came down, and they came down more than they normally do. As a result, the bar is much lower for S&P earnings results this quarter than they were last quarter. So I'm actually optimistic that more companies can beat. Another thing to mention is that earnings estimates are expected to accelerate in the fourth quarter. So we're looking for about 4% growth in Q3. That rises to 10% in Q4. And then the final point is for the year, analysts are looking for about 9% earnings growth. But for next year, they're looking for an acceleration up to 14%. And you obviously will ask, why is it accelerating? Well, energy, materials, and healthcare are all forecasted to have better earnings in 2025 than 2024. So if this all does play out, indeed, Q3 will be the low point, and it'll get better from here.
Well, one sector that has been doing phenomenally well, obviously, is financial services, and we do have JPMorgan and Wells Fargo reporting on Friday. The stock price for both of those up handsomely on the year. Are they topping out in your view?
So the story with financials is that I think this quarter is going to be pretty lackluster. They're still not really seeing much expansion in net interest margin. Net interest margins have been under pressure because as the Fed raised rates, banks had to offer higher rates of deposit to consumers to attract their money. Going forward, as the Fed lowers rates, it's hopeful that the curve will steepen. Banks can offer lower deposit rates, and you can get an expansion in net interest margin. That has not happened yet. The other thing I think that's very important as we look ahead to next year is that in 2024, you had very slow equity offerings and you had very little M&A. I'm optimistic that both of those are going to pick up next year. So the large money center banks that also have investment banking operations, I think can have much better 2025s than 2024s. But that hasn't started yet, and this is going to be likely a very ho-hum quarter.
Well, if it does turn out to be a ho-hum quarter, as you put it, then we may see people starting to go a little bit defensive. And we did have a guest earlier this week saying that the smart money at the moment should actually be going into healthcare stocks. What do you make of that as a piece of advice?
So healthcare has been a real sector of have and have-nots. Overall, healthcare stocks have lagged the overall market. And one of the reasons for that is that their earnings growth has been much lower than areas like technology. So I think I would not make a broad statement about healthcare. I do think, however, much like I mentioned a minute ago, I think M&A can really pick up next year in the healthcare sector. I think we're going to see more consolidation. I think companies with innovative products and services can grow. And indeed, a lot of those stocks are cheaper than similar growth rates in other sectors. But I think it's tough to paint a broad brush right now of that because there is such a divergence in individual company performance.
Well, that's fair enough. Do you think we could get you to paint with a broad brush on anything else? What have you actually got your eye on, particularly this season?
I think there's a lot of uncertainty right now in the market because of the U.S. presidential election, because of, unfortunately, the two regional wars. But I think we could have a scenario over the next 6 months where the election gets behind us. Hopefully, some of these wars can calm down a little bit for a variety of reasons, obviously not just the market. And then you can have the Fed easing more. I think all of those could set you up for a pretty good end of the year rally and an optimistic start to 2025.
Well, that would be a very fine thing indeed. Thank you very much indeed for your time today. Randy Watts, Senior Portfolio Manager at O'Neill Global Advisors. And that is Market Insight. Don't forget, you can watch more videos on Reuters.com.